In this section, I will go over finance for small and medium-sized entities, otherwise called SMEs. In this section, we are going to look at the financing needs of small businesses, the financing problems for small businesses, solutions to solve small businesses' financing problems, and the financial impact of sources of finance for SMEs. The financing needs of small businesses. Small businesses, like large ones, need money to fund their activities and working capital. Yet it can be much more difficult for smaller businesses to get finance than larger ones. Small businesses often find it very difficult to get credit, but they are in the difficult position where often they have to offer credit to their customers to remain competitive. Small businesses are typically new and without a track record or a history, and it is very difficult to secure finance as they are seen as riskier than larger organisations by financiers. Small businesses need to fund their startup costs, be able to supply credit to their customers, which is one aspect of their working capital that they will need to fund. As well as these costs, they need to fund. SMEs will need funds for their future, to grow their business, to invest in profitable projects. Financing is extremely difficult, as you can see, for smaller organisations, and the sources of finance available to them are limited, and much more so than the sources available to larger organisations. Typically, the sources of finance available to an SME is retained earnings, so these are previous year's profits, bank borrowings. Bank loans can be very difficult for small businesses to get. I'll go over the reasons for this on the next slide. It is often remarked that SMEs can get a long-term loan, such as a mortgage, and not a short or medium-term loan. This is referred to as the maturity gap, and it means that SMEs can find it very difficult to match short-term projects with short-term finance if the only source of finance available is a long-term source. Why is this? Because long-term loans are easily secured or easier secured by an asset which the company could have. So you could secure a long-term loan such as a mortgage against a company property. However, the bank will not offer a short-term loan with the same asset against it, and the company will not have the track record to get the short-term loan. Another source of finance available is from seeking additional finance from their current shareholders. So, for example, a rights issue. It is quite difficult to sell additional shares in a small company, much more so than for a larger quoted company. To seek money from existing investors assumes that they have the finances to invest, which is often not the case. Often, a small company's main investors are the founders themselves, who have already exhausted their savings trying to set up the business. Increasing your investment in an SME is not very attractive for many investors, as they will not be able to sell their investment as they could on the stock exchange. Another point I want to make is that these are unlike stock exchange investors who have studied the market and buy shares to diversify their portfolio and to get high returns, etc. Often, SME investors invest for a very different reason. They invest because of, say, a friendship, or because that they really believe in a product or the service being provided. SME investing is very risky, as most do fail within 2 years. A funding gap occurs when SMEs want to expand and need more finance than what is available to them. but they are not yet big enough to get access to the funding available from the stock exchanges. They are not ready or able to apply to the stock exchange or the alternative investment market for a stock exchange listing to raise this finance. Financing problems for small businesses. So the lack of available credit is a big problem for SMEs. Why is this? As I already said, they are often new businesses, so they have no credit history. Often they have no assets that can be used as collateral. Also, smaller businesses are more vulnerable to market forces. Therefore, their situation can change quickly. This volatility would deter financiers, and if they do decide to lend, they will monitor the activities of the SME and can place many restrictions on them. So, by now, you should be fully aware that it is difficult for SMEs to get finance, and they face difficulties such as lack of collateral, the maturity gap, and the funding gap. So what can be done to ease these problems? Here are a few alternative sources of funding that can bridge the funding and the maturity gap. Venture capitalists. They offer finance for an equity stake in a business. They give large sums to high growth companies. Venture capitalists are a department of most major finance providers. Since they don't offer smaller funds than typically less than $100,000, for businesses seeking a smaller investment, there are business angels. Business angels are wealthy individuals who typically offer smaller sums to high-growth businesses. Often, they offer business expertise to help that startup. This is a very risky investment for the business angel. So they will want a high return or a big stake, as in percentage ownership in the company for their investment. Are you familiar with TV shows such as The Dragon's Den or The Shark Tank? The investors in these would be classed as business angels. I recommend you watch an episode of these shows. Although they are for entertainment purposes, they will give you an idea of what this type of investor wants to know. Another financing option is crowdfunding, which is also called peer-to-peer financing. This is where businesses seek funding from the public at large. They may want to raise $100,000, but each investor may donate as little as, say, $20. The business will showcase their product and display their future plans, and sometimes pre-sell their product. This is a very popular option for startups, as it serves as a marketing platform, and the organization can test their product on the target market and assess the market's reaction to their offering. There are fees to be paid with this source of finance, and normally, if the organization does not reach its target investment, they don't get the investment. So it can create pressure. Check out the crowdfunding website Kickstarter to get a sense of what information companies are providing. Supply chain financing is where the organization can get credit in their supply chain to fund working capital. So, for example, they get 30 days credit from suppliers, or perhaps customers pay in advance for a product or service. It is hard for new companies to get trade credit, but if they do, it's great because it's free. Government intervention. Small businesses and startups are very important to the economy and to the country's jobs market, so governments often take measures to fund them. There are two main ways this is done. They increase the marketability of the organisation's shares, or they can provide tax incentives to the investors. Increasing the marketability of an organisation's shares has been done in some countries by creating a small firms market. By creating this, smaller organisations can sell their shares more easily than before to the public, raising equity. This is also much more attractive to those who are investing because it increases the marketability of the shares and they can sell them on if they need to realise their investment. Providing tax incentives to investors, to small firms, means what it says. It often gives investors who have a high tax bill a win-win situation. They can offset some or all of their investment, even if it is profitable, against their tax bill, depending on the type of tax incentive being offered, of course. This takes a lot of risk out of investing in smaller firms, so if the investor doesn't receive a return on their investment, they can still reduce their tax bill. Governments often use these types of incentives to stimulate areas in the economy. So, for example, to develop environmentally sustainable energy or the film industry. Other ways governments assist SMEs is by providing grants and small loans. These are very useful for organisations who cannot access bank financing.